Hello, Chuck Corger here with Carson Choice Retirement Solutions. In our last video, Rick talked with you about the recent market volatility and just how unsettling that can be. Today, what I want to talk with you about is how we can employ a disciplined rebalancing strategy to make sure that we don't trade based on emotional impulses when the inevitable happens and things do get unsettling in the markets. So what is rebalancing? Rebalancing is really just when we start with a target asset allocation for our portfolio, meaning a predetermined mix of stocks, bonds, cash, maybe alternative investments, that is designed entirely for you to meet your goals, your risk tolerance. You may be wanting to retire in a certain number of years. You may have goals for children's education, starting a business, any number of things. But we would first design a portfolio with percentages in each of the various asset classes that's based on your goals and your risk. And then we reallocate those assets back to those target allocations once things get a little bit volatile in the marketplace. So we may start with a certain asset allocation, and markets can change over time. Certain asset classes like stocks may outperform over a period of months or over a period of years, or they may underperform. And when that happens, that seesaw effect of different asset classes, your portfolio that starts out with one target allocation may look very different over time. Let's take a look at this example from Merrill Lynch Global Wealth Management 2015 asset allocation. How an asset allocation can change over time. So let's consider James, a somewhat cautious investor who at the end of 2008 chose a moderate level of risk for his portfolio and the corresponding asset allocation of stocks, bonds, and cash. As the stock market marched upward, James did not make any changes to his portfolio. By the end of 2014, his allocations and his risk level looked very different from his selected target allocation. You can see on the left in December of 2008, James had about a 35% allocation to bonds, 60% in stocks, the remainder in cash. When the equities continued to march after the market downturn, he ended up with 75% stocks and 22% bonds, or in other words, a much higher level of risk for his portfolio than he originally intended. Because he didn't rebalance the portfolio at any time over that 6-year period, this allocation is much more aggressive than he may be comfortable with. So in that example with James, his portfolio actually ended up with a much higher stock allocation than what he was comfortable with. And if the stock market took a major downturn, his portfolio would have probably taken a much larger drop than he's comfortable with. The problem is that discomfort is what makes investors sell. We may have a very disciplined strategy, but once we go beyond our comfort level, it may be too much for many investors and they'll end up selling their stocks at the absolute worst possible time. It's typically the time when you should either be sticking with it or even rebalancing in to buy low into those areas. The 2012 study from Learsh and Sooney showed that investors can lose up to 5% of their value by trading based on emotional impulses rather than just sticking with a disciplined rebalancing strategy. So it's for these very reasons that we want to avoid trading on emotional impulses and stick with our disciplined strategy. Because what many people do, at the end of the year, they'll look at their statements and they'll be going through and they'll say, wow, this investment I have here, this thing's been amazing. It's just shooting the lights out. This one's a dog. You know what I'm going to do? I'm going to sell that dog and I'm going to load up on this one that's been doing just great. And if you really think about that, what have you just done? You just selling that dog, you just sold low, and buying the recent high performer, we just bought high. In other words, we did the opposite of what we know a disciplined approach should do. Rebalancing brings those emotions off the table and forces us to sell high and buy low. If you can stick with that, you'll be much better off and you won't have to worry about the ups and downs of the market. They're going to work to your advantage. This has been Chuck Corger with Carson Choice Retirement Solutions. We'll see you next time.